In Bill Gates' 2021 book, How to Avoid a Climate Disaster, the American businessman and now prolific and highly influential investor via his charitable foundation lays out suggestions for what he would deem to be a comprehensive climate plan to meet the required path of decarbonisation. Gates explores how many different disciplines, from biology, chemistry and physics, through to political science, economics, engineering and other sciences, will all need to be combined. Gates believes it's a mistake to think of innovation only in the strict technological sense of inventing a new machine or process, but instead should be viewed as coming up with new approaches to business models, supply chains, markets and policies. It is clear what lies ahead is a hugely challenging quest to reduce the impact we have on the environment and to develop more sustainable practices. This journey is likely to be hugely disruptive and have far-reaching consequences. In today's episode, we discuss some of the investment opportunities presenting themselves from companies providing solutions to help reverse ecological damage and increase resource efficiency across a wide variety of industry segments, from energy, agriculture, water, waste and pollution control. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. Today we are joined by Yi Shi from Pictet Asset Management. She joined Pictet in 2022 as a client portfolio manager and engagement specialist within the company's Thematic Equities team, having previously worked at the Royal Bank of Canada, advancing the company's environmental, social and governance or ESG integration into the business's equity investments and research. Prior to that, she has an impressive and highly relevant academic resume. Pictet run a range of thematic equity strategies, including the Global Environmental Opportunities Fund, which we reference in today's discussion. The philosophy behind all of these thematic strategies is that market analysis is often too short-term and therefore underappreciates the structural, sustainable and persistent growth drivers of many long-term technological, environmental or societal megatrends. In the case of the Global Environmental Opportunities Fund, the strategy focuses on businesses providing strong environmental credentials and which are actively involved in providing solutions to help reverse ecological damage and increase resource efficiency. Shi, thank you so much for joining us. Good afternoon. How are you?
Very well, thank you. Thanks for inviting me to the call. Yeah.
No problem at all. So the first question that we always ask, and listeners will kind of hear this repeated question, but it tries to get a bit of a kind of insight into you and your kind of typical working week or kind of meetings that you've been involved in. So I wondered if there was kind of any anecdotes that you could share, whether it be a kind of meeting or a research trip, or even just an article that you've come across or a book you're reading at the moment. So anything you could share with that regard?
Definitely. So I have a pretty interesting role because I sit I sit in the middle, the nexus of clients, companies and investment teams. So I get to speak with company management as an engagement specialist. So there are definitely some very interesting meetings we've had recently. So recently we did had a couple of calls with the management and board of water utilities companies, and specifically we were talking to the board chair of one of the water utility about the remuneration design, so executive pay design. So on that, there was a fair bit of debate actually, because in this particular market, things are changing. They're moving from one asset management period to another. So the board has to adjust their remuneration accordingly. Now, how do you adjust it? And there are lots of consideration going in there, and whether it drives management performance or not, it's a key question for us. So when we were talking to the board chair, and one of the points that we raised is that to incentivize management performance, we need to focus on not just the quantity of metrics. So currently they were focusing on the coverage, the quantity of metrics collected about water monitoring, etc., pollution monitoring, whereas we want to focus on also the quality of metrics, as in if you have sort of a runoff, in this case it's a specific technical word, but it's called combined sewer overflow. Basically, you have when you have a storm, your sewer basically overflows, spills over. Pretty big issue in a number of countries. When you have issues like that, how do you monitor that particular data point? Do you just log it as one event, or do you log it as something with certain volume issues? What is the volume of that pollution? What is the quality? The quality basically of the data. So understand the not just the number, but also the depth of these sort of water issues. So we thought it was interesting. It was a bit of a debate, right, going back and forth. And obviously, companies typically we invest in are typically best in class in their industries, so they would think that they are fairly far ahead of their peers. But at the same time, when we are judging from the actual problem, how far are we from solving the actual problem? There is still definitely a distance. So sort of really trying to do that diplomatically, trying to do it collaboratively with the company and the board. It's something that I do on a fairly often weekly basis, actually.
Yeah, no, interesting insight into how your meetings would work and the differentiator there. Yeah, thank you for that.
Yeah. And did you mention a book or an article?
Yeah, if you've got one to share, always keen for a book recommendation. Yeah.
So I'm a bit of a nerd. So I am also a millennial. So I combine the. I'm not just reading the physical books. So I sort of look at online lectures, papers, and articles, stuff like that. So I was looking at two articles in tangent together recently. One is called Rational Sustainability. It's a paper published by Professor Alex Edmonds from the London Business School recently, specifically tackling this issue of ESG/anti-ESG question, right? So, and then another paper is called Famine, Affluence, and Morality, and that's done by the famous philosopher Peter Singer from 1972, tackling the question of effective altruism. So I like to read very different things together because it gives you additional thoughts, it generates ideas. On the one hand, we're trying to rational sustainability is trying to tackle the question of investing without going to the ESG labels, but focusing on doing something that is actually focused on long-term sustainability. Right? This is fairly aligned with what we do at Pictet, but it really is about investing in a sustainable business. Sustainable, the word itself doesn't really carry anything, financial, non-financial, ESG, non-ESG. It's just how can a company stay alive for a very long time and do well and prosper, right? And then on the other hand, so this is very interesting to me. And then the other paper on famine, affluence, and morality is really thinking about our impact as individuals, and in our case as investors. How do we think about impact? And it's obviously at the end of the day, it's really about values and principles. So it was a very controversial and very interesting paper still being discussed today. So I just thought, I was reading both together, and I thought it was fun to really contemplate about the question of sustainability and impact.
Yeah, no, two very interesting papers. Yeah, no, thank you for sharing that. Yeah, very interesting. So my next question was, we don't tend to focus too heavily on investment process in these particular discussions. We tend to kind of save that for our research notes, which kind of go into that in reasonable detail. But I think in this instance, understanding how Pictet kind of analyze environmental impact, and you talk about the kind of assessment of planetary boundaries. That's, I think, how you term this. I think it's just would be useful just to frame the rest of the discussion. So I wondered if it's possible to kind of briefly describe how you implement that framework and derive your kind of universe of investment, if that's possible.
Of course, yeah. So, whenever an investor, asset manager like us, are thinking about designing a product and sustainably managing a product, we have to always we have to create and construct an investable universe that is aligned with our investment and impact objectives. And how do you get the world equity universe, which is 45,000 stocks around, to a manageable couple hundred kind of a stock universe? There are many, many ways to do it, but in our case, because we are an Article 9 SFDR fund and also impact-based, so a finance-first impact strategy, we really think about how to leverage the framework, which you mentioned, planetary boundaries framework, to narrow down the universe efficiently, but really aligned with where we are going, right? Aligned with our impact investment objective, the environmental objective. So essentially, there are two steps here. First step is exclusion. Second is inclusion. The exclusion, besides applying the standard sort of exclusion principles and frameworks, and we have our own at Pictet as well, of course, and the UNGC. We are also implementing an exclusion framework using the planetary boundary. So what is that? So this is a framework developed in 2009 by the Stock Market Resiliency Center, Professor Johan Rockstrom, as well as a group of 30 international scientists, well-known scientists, who published a paper on Nature. They basically look at the Earth across 9 different environmental boundaries. So examples such as climate change, such as biodiversity, water, freshwater use, etc. So ozone, etc. So you have these 9 planetary boundaries. And the thinking is that we cannot only look at 1 or 2 dimensions of the planet, because if we're only focusing on solving one problem, it's sort of like whack-a-mole. You're putting all your resources into climate change mitigation, and then on the other hand, your factory is sort of polluting, right? You're spitting out or taking too much water, polluting the environment with chemicals. It's actually crossing the boundaries elsewhere. So we think, first of all, the scientific framework here is defined in such ways so that we understand there is a limit to how much we can pressure the planet, and we need to operate within what we call the safe operating space. So what we do is essentially we identify companies that are operating within the safe operating space and exclude companies that are outside of that safe operating space. And then afterwards, we are then trying to identify companies that are whose products and services are contributing to relieving the environmental pressure on one of the 9 planetary boundaries. So step 1 is do no significant harm, leveraging the planetary boundaries framework. Step 2 is do environmental good by focusing on 1 or more of the 9 planetary boundaries.
Yeah, no, that makes sense. Yeah, and I like the whack-a-mole analogy. That puts it nicely into context. And so maybe if we kind of delve more into the strategy itself. So the Environmental Opportunities Fund can invest across quite a variety of environmental segments, whether it be kind of energy, agriculture, water, waste, etc. Are you able to maybe pick a couple of specific segments just to give us a kind of flavour of what's in the strategy? Maybe describe some of those areas of industry that you're particularly focused in to capture the investment returns within each theme.
Definitely. So we've got 7 segments in this multi-trillion dollar market, growing at high single digits per annum. We look at 7 things. So renewable energy efficiency, and something interesting called dematerialized economy. A lot of people don't know what it is. And then we also look at sustainable agriculture and forestry, water technologies and supply, waste management and recycling, and pollution control. Now, 2 areas I can talk about now. One is energy efficiency. So energy efficiency is fairly core to decarbonizing our economy. So the reason why we invest in this particular segment is because the companies that we invest in are solution providers across board, but for this one as well. They are solution providers. So that means they are enabling their customers to reduce energy, right? So they themselves may also reduce energy, right? Improving the energy efficiency. But it's the revenue that matters here, right? The revenue is tied to the products and services. Products and services is trying to solve a problem out there. So it's impact focused by nature, right? These companies, they may not, not all of them will put in their mission statement and say, oh, we are here to solve climate change. Of course not. But however, if you look at their products and services, they are fundamentally trying to mitigate, right, the energy consumption or excessive energy consumption and improve energy efficiency. So you find that so industrial efficiency companies like Eaton or Schneider, building efficiency company, etc. So that's energy efficiency. If I were to take another one, which we find fairly interesting, especially over the past year, it's one of our subsegments within pollution control. So within pollution control, we have the so-called life sciences and tools, companies that are testing for pollution, but we also have companies that are engineering consultants that are designing projects to sort of tackle environmental issues, sustainable infrastructure, etc. So there's some very interesting and well-managed engineering consulting companies like AECOM or Tetra Tech, and they all have global footprints when it comes to developing sustainable projects, infrastructure projects around. And it's particularly interesting over the past 2 years because of the supportive legislation coming out of the United States, which is the Infrastructure Investments and Jobs Act, the Chips and Science Act, etc. All of these are driving this massive super capex cycle. So that is sort of really giving that extra bit of tailwind to these companies, both on the engineering consulting side that I mentioned, and as well as the sort of industrial efficiency and building efficiency name as well. So they're also benefiting. So maybe to give you a very concrete example, when say Intel or Samsung is building a facility in Texas or Arizona, who's going to design the site, right? Who's going to design the piping, all that sort of things? Where does the water go? How does a project get built? There is an engineering consultant that's behind this, right? At the same time, once you build the factories, you got to make sure that it runs efficiently. It is smart, right? So it is optimizing energy management. So you need companies like the industrial efficiency companies as well. So you see a number of our segments kind of interacting, all coming together in this particular scenario.
Yeah, no, thank you for that. Some really interesting examples. You touched kind of halfway through that answer on kind of supportive legislation that's out there, and I mean there is a number of scheduled elections this year. I think it's one of the biggest. I think documented as one of the biggest years for elections. Difficult to go through a day without having some news flow on some election around the world at the moment. I mean, it is clear from talking to you and others investing in the kind of environmental areas that we are sensitive to government policy here. Clearly, are you approaching this year kind of any differently, or is there anything that you're doing kind of as we lead up to some of these election dates?
Yeah, so it's interesting because this was a question that we obviously thought about fairly in depth since last year. At Pictet, we're fairly different in terms of our Thematic Equities team, because we have this additional resources called the external advisory boards, the Thematic advisory board. So we have one of the most renowned environmental lawyer, U.S. environmental lawyer, on our board on one of our strategies. And then we get to speak with them, right? And also other advisors about this particular issue. In the U.S. election specifically, we can also speak about the Taiwan election, which was also fairly important, that has passed. And thankfully, all went okay. So that's good. And so when we were talking about elections, first of all, we need to know that we need to separate what is short-term and what is long-term, right? So there are a lot of noises. Noises are noises, but it's not going to affect our long-term conviction on the company, especially if we know there's no long-lasting impact from, say, a certain election. However, there are sometimes potential impact from the electing a new leader, right? So in the United States, obviously, there's consequences to the changes in legislation and potential ones if President Donald Trump is elected, or President Biden is continues, right? So in those cases, we need to conduct scenario analysis. And what are the most relevant legislations to us? I mentioned two of them: Infrastructure Investments and Jobs Act, IIJA, the CHIPS and Science Act, and then there's also the famous Inflation Reduction Act, right? So that is sort of top of mind. The third one is sort of top of mind amongst many investors, mainly because, it's not like a usual legislation where once the sort of money is earmarked and that's it. You can't really repeal it. But in this case, because it's tax credits, and there's also some impact from executive orders, so there could be potential changes to it if the new legislation, new administration decides to make any changes to this particular legislation. However, we have to also think about what is our exposure, our actual exposure, earnings in terms of or revenue and earnings exposure to these legislation. Not for us is fairly minimum on the Inflation Reduction Act, because most of the credits goes into green transportation and renewable energy. So our exposure to those are fairly limited, mainly because it's also the industry themselves are going through a lot of changes, renewables, and the sort of green transportation side as well, the EVs. So it's not easy to find a company that has good, stable earning visibility and strong management track record and to the level of quality that we like. So in this case, we look at, as you see, I'm sort of showing you how we're thinking about this analysis. We think about exposure to law, and we think about what could potentially have an impact. We conduct scenario analysis, and we feel comfortable with the risks we're taking. And in this case, we have fairly minimal exposure, whereas our bigger exposure to the other legislations are not going to be affected, at least from our channel checks, from our speaking with our advisors, and etc. So,
yeah, no, that's interesting. Yeah, thank you for running through. Interesting to hear how you run through scenarios like that. Our standard kind of final question that we've used to come to some conclusion is to ask people what their kind of highest conviction area is at the moment. So it doesn't necessarily have to be a single company. You don't have to pick your favorites. It can be an area of an investment. But if I was to say kind of where you had particularly high conviction in at the moment, would there be one area that you'd highlight?
So I've mentioned energy efficiency and the engineering consultants, which we fairly like. We think there are some supportive tailwinds in general. And then there's obviously the general trend towards energy as a long-term secular growth trend on achieving net zero, right? So getting ourselves to that point. So energy efficiency is definitely driven by some of those sustainability needs, policy drivers, and consumer preference change. So I also saved a good bit, right? A good segment that I didn't talk about, which is dematerialized economy. So this is an area where it's where we invest in companies in upstream design. So why is upstream design important? If you think about circular economy, right? So how do you get an economy to be circular? So that we are not, polluting environment. Our net impact on environment or nature is, zero, as close to zero as possible. It requires design. If I'm not, if a car is designed to be made out of steel and made out of energy intensive, run on energy intensive fuels, right, carbon intensive fuels, from the start, there's nothing you can. You can try to mitigate it downstream, but you're not solving the source of the problem, are you? So we have to design something from the start to minimize waste, minimize energy consumption, right, and other environmental footprints. So design is super important to us. So what kind of companies do we invest in? So we invest in companies like electronic design automation in semiconductors, which enables these semiconductor manufacturers to put together billions of transistors on a single chip, right? To actually put these very, very complex designs onto one little tiny chips. And that requires a lot of coordinations. It requires logistics and automation. So there are design software companies that are in these areas, such as Cadence and Synopsys. They are obviously market leaders, tier one players. There are also other areas, upstream design. So in the building, there's building information modeling, trying to make building run more efficiently, right? Manage the buildings as a building software, right? and engineering software in terms of designing, say, an engine, designing or a car or a bike or anything, just to minimize resource use. Just think about how far we've come from the 1980s, where our cars looks like chunks, right? Now, look how streamlined they are, and it's important in terms of energy, waste, and resources savings, etc. There are also other areas like simulation softwares we also look at. But in general, we feel that this particular area has long-term, is supported by long-term secular growth. That typically we can find high-quality companies. We very much like this area. Now, obviously, they are also related to software industry. So as a software in the market has a pretty high valuation, so we will take profits accordingly. So we exercise our valuation discipline. But fundamentally, over the long term, we are fairly positive in this particular area.
Yeah, no, thank you for that. I'm glad you saved that to the highest conviction bit at the end. So yeah, thank you. Thank you so much for your time. Really, really interesting to chat to you today. Thanks a lot.
Brilliant. Thank you so much, Gordon.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.